If I told you right now that in 2026, 5 types of assets could plunge in value and suffer severe losses, what would you think? Most people's first reaction is predictable. Which assets? Do I own any of them? If the answer is no, they assume it has nothing to do with them. And if someone has never bought any kind of asset at all, they'll likely believe this story won't affect them either, right? But if you truly think that way, then I have to tell you, you may be missing a very rare opportunity. Because in investing, sometimes knowing that an asset is about to fall matters even more than knowing it will rise. Let's break this down carefully. Making money even when assets lose value. That's the mindset of great investors. Welcome to Unsaid Truths, the place for truth society rarely says out loud. Many people believe that they can only make money when asset prices go up, but in reality, the opposite is often true. If you understand how to take advantage of market volatility, you can make money even when asset prices are falling. Imagine this scenario. A house in a major city was once worth $1 million, but by 2026, its price drops to around $500,000. Now assume that at the same time, the Vietnamese currency weakens significantly while the US dollar strengthens. If you understand this shift, you can act immediately. For example, you sell your house for 25 billion VND and convert that entire amount into 1 million US dollars. When the Vietnamese currency loses half of its value, that $1 million can now be exchanged for 50 billion VND. What does that mean? You've effectively gained an additional 25 billion VND without waiting for real estate prices to recover. Even if the house you sold still cost 25 billion VND later on, you could now buy 2 houses instead of 1. In short, if you truly understand how markets operate, you'll realize that falling asset prices are not a disaster. They are a rare investment opportunity. Lessons from history. When everyone panics, the wealthy grow even wealthier. Did you know that some of the best opportunities to make money appear during market crashes? Let's look at history. During the global financial crisis of 2008, Warren Buffett bought massive amounts of stocks, while everyone else was panicking. As a result, he became one of the biggest beneficiaries of the recovery that followed. Li Ka-shing, the wealthiest billionaire in Hong Kong, took advantage of the collapse in real estate markets to acquire assets at extremely low prices. When the market recovered, he doubled his wealth. The Dow Jones Index took 3 years during Donald Trump's presidency to rise by 49%. Yet in 2020, it took just 1 month to fall by that same 49%. Those who bet on the market's decline made enormous profits in a matter of weeks. Those who bet on the market's decline made enormous profits in just a matter of weeks. You see, when markets collapse, most people panic and run away. But smart investors see these moments as golden opportunities to expand their wealth. So instead of fearing bad news, learn how to turn it into an advantage. 2026, a once-in-a-decade opportunity. Will you be the winner or the one left behind? Markets always move in cycles of ups and downs. And 2026 could be one of the years when many asset classes experience their sharpest declines. But that doesn't mean we should sit still and watch our wealth evaporate. Remember this: a successful general is someone who knows how to use the battlefield, when to advance and when to retreat. Not someone who blindly charges forward in every situation hoping for victory, or runs away in fear when the opponent seems stronger. So the real question is this: will you be the general who leads the game, or just another skeleton swept away by the market's tide? If you don't want to miss this opportunity, if you want to truly understand which assets are likely to lose value, and how to turn that moment into wealth, then keep following this channel. In the next sections, I'll reveal 5 types of assets that face the most serious risk of collapse in 2026, and how you can use that knowledge to stay one step ahead. Get ready, because this is an opportunity that comes only once every 10 years. Open your third eye, see through the flow of global money. Before we move on to the next assets likely to lose value in 2026, there's one crucial thing we need to do first. Open the third eye. You might be wondering, what is the third eye? Humans only have 2 eyes, don't they? Let me explain. If you only use your physical eyes to observe the world, you'll see only what's happening right in front of you. But if you learn how to see through the flow of money, where money comes from and where it goes, you'll begin to understand the true nature of the market. And once you understand that, you can start to anticipate the future. Financial markets operate much like a chessboard. To win the game, you must understand the rules. You need a new way of thinking to spot opportunities in 2026, starting with one fundamental question. What is money? Money is not the same as currency, it is a force in motion. Most people believe money is simply money. But in reality, money by itself does not necessarily function as currency. Why do I say that? Imagine having piles of cash that cannot be exchanged for anything of real value. Does that money still matter? Why do I say that? Let's imagine this for a moment. Suppose you have a huge pile of money, but that money can't buy anything of real value. Does it still have any meaning? Take the Zimbabwean dollar as an example. You could hold 100 billion Zimbabwe dollars, yet sometimes that amount wouldn't even be enough to buy a single loaf of bread. Or think back to 2010, when someone once spent 10,000 bitcoins to buy a pizza. At that time, Bitcoin wasn't truly money yet, because it couldn't be widely exchanged for goods and services. Money only has real value when it can be exchanged for things that many people want. A perfect example is the US dollar. Why can the United States print money so freely without the dollar completely collapsing in value? The simple answer is this. The entire world wants dollars, and dollars can be exchanged for an enormous range of goods globally. You can use US dollars to buy diamonds in Africa. You can use them to buy electronics from Japan or South Korea. In many movies, you'll even see people using suitcases full of dollars to trade for illegal goods or weapons. That's why the dollar has managed to maintain its value despite continuous money printing. But what happens when trust in the US dollar begins to decline? The first asset to lose value is US government bonds. US Treasury bonds have long been considered the safest asset in the world. But in 2026, that assumption may begin to change. There's something very few people are paying attention to. US government bonds are quietly being sold off in the market. Right now, a US Treasury bond with a face value of $100 is trading on the secondary market for just over $90, even though it still offers an interest rate of around 5%. This is a clear warning sign of stress in the system. In the past, the United States could easily borrow money from countries like Japan, China, and the United Kingdom. But today, these countries are gradually reducing their holdings of US Treasuries. Think about it for a moment. If people are eager to lend you money, you can borrow at low interest rates. But if no one wants to lend to you, you're forced to raise interest rates to attract buyers. That is exactly what is happening to the United States right now. And remember this, the higher the interest rate, the lower the price of bonds. So if you're holding US government bonds, the value of your assets is slowly evaporating. The second asset at risk of losing value is cash, especially domestic currencies. Ask yourself this. Why are countries like Japan and China no longer eager to hold US government bonds? The simple reason is that trust in the current monetary system is fading. When this loss of confidence spreads, domestic currencies are often the first to suffer severe devaluation. History gives us many examples. The Japanese yen has lost nearly 50% of its value against the US dollar in just over a decade. The Argentine peso has lost more than 90% of its value in only a few years. Many currencies across Asia and Latin America have also experienced continuous depreciation. So what will happen to weaker currencies in 2026? If you're holding too much cash in local currency, you may be facing a serious risk of devaluation without even realizing it. One possible solution is to consider holding part of your assets in US dollars, gold, or other assets with greater stability. The third category of assets at risk includes financial markets that depend heavily on bonds. You might think, I don't own US bonds, so this doesn't affect me. But the truth is, the global financial system is deeply dependent on US government bonds. When the value of US bonds declines, many investment funds, banks, and financial institutions are exposed to serious risk. This can trigger turbulence in the stock market. Real estate comes under pressure as high interest rates make borrowing more expensive. Investment funds suffer losses, and individual investors are affected as a result. Remember this. When trust in the financial system weakens, the damage doesn't stop at bonds. It spreads across the entire economy. So why are countries around the world pulling away from US government bonds? Before we move on to the next asset likely to lose value in 2026, let's pause and think. Why are countries like Japan and China reducing their holdings of US treasuries? The reason is actually very simple. When a country buys US government bonds, it is essentially lending money to the United States. But look closely at how that money is being used. The US is not investing heavily in manufacturing or technological innovation. It is not using this capital to significantly improve productivity or strengthen the real economy. Instead, much of this money is being funneled into financial corporations and massive debt-laden institutions. In other words, the US is using new money to pay off old debt. If you were a rational investor, would you willingly continue lending to a debtor like that? When major countries no longer want to buy US bonds, the inevitable outcome is clear. Bond prices fall, and interest rates must rise to attract buyers. But this shift doesn't happen in isolation. It creates a chain reaction that negatively affects many other asset classes. The fourth category of assets at risk includes dividend-paying stocks and other fixed-income investments. Now think like an investor. If you had $100, where would you put your money? Would you choose a US government bond priced at $93, offering a 5% yield with relatively low risk? Or a stock priced at $100 that pays a dividend of just $3 per year, an effective yield of 3%? The answer is obvious. If bonds are safer and offer higher returns, there's little reason for investors to buy dividend stocks. So what happens next? Stock prices must fall further so that dividend yields rise and become competitive with bonds. If a stock pays $3 per year in dividends but needs to offer a 5% yield to compete, its price would have to drop to $60 instead of $100. The result is clear. Dividend-paying stocks, often considered safe investments, can lose significant value. Investors who bought these stocks for passive income will see their portfolios shrink. Pension funds, insurance companies, institutional investors, and anyone relying heavily on dividend-paying stocks will suffer substantial losses. And this also means that in 2026, dividend-paying stocks will become the fourth asset class to suffer major losses. But wait, this story doesn't end there. The fifth asset class at serious risk is commercial real estate. There is another type of asset that is being heavily impacted by shifts in capital flows, and that is commercial property. Think back to the time when the pandemic erupted. People were forced to work from home. Office buildings were left empty. Consumer habits changed. E-commerce exploded, leaving shopping malls and physical retail stores struggling. Rental prices collapsed, and property owners could no longer generate enough income to service their debt. Today in the United States, large numbers of office buildings and shopping centers are sitting vacant with no tenants. As a result, the value of commercial real estate has fallen sharply. Many owners are unable to repay their bank loans, leading to widespread defaults. Banks step in, seize these properties, but no one wants to buy them. Banks suffer massive losses because the collateral backing their loans has lost value. And remember this, banks don't just hold real estate. Their largest assets are government bonds. And this isn't happening in just one country. We're seeing it across the globe, in China, Japan, South Korea, and even Vietnam. Now, put all the pieces together. US bonds are losing value. Commercial real estate is collapsing. Banks are taking heavy losses from both sides. Does this start to sound familiar? Doesn't it resemble the 2008 global financial crisis? It's no coincidence that Warren Buffett has sold all the US bank stocks he once held. He saw this risk coming long ago, and that is why commercial real estate will be one of the assets to suffer severe losses in 2026. So where is capital flowing now? In the past, the global flow of money followed a very simple cycle. First, the United States printed dollars to buy goods from China. Second, China received those dollars and reinvested them by buying US government bonds. Third, the money flowed back to the United States, allowing this cycle to continue endlessly. But today, that cycle has begun to break. Why? Simply because US bonds are no longer selling. Countries no longer want to buy US treasuries. Instead, they prefer to hold cash. But here's the problem. Cash without goods to exchange for eventually becomes meaningless. Just like when 10,000 bitcoins were once used to buy a single pizza. So what does the United States do next? It needs a new asset to keep the dollar circulating, and that asset is US stocks. This is a new strategy. Instead of selling bonds, the US is selling you stocks. Have you noticed that recently, the US has been releasing a steady stream of positive economic data, especially strong employment numbers? They are trying to create the image that while the rest of the world is struggling, the United States remains the strongest economy. The message is clear. The US economy is booming. The US stock market will continue to rise. Why do they need this narrative? Because they want to sell you US stocks. They want you to believe that even if US bonds are no longer attractive, US stocks are still a safe haven. And this is also why Donald Trump has pushed for strengthening U.S. manufacturing and cutting taxes for small and medium-sized businesses. But here's the real question. Aren't Trump's actions also putting pressure on the stock prices of major global financial corporations based in the U.S.? Wake up! Companies like Apple, Nvidia, Meta, and Amazon already have extremely high market capitalizations. Their room for future growth is no longer that large. Trust me on this. When the U.S. truly succeeds, a wave of new companies will emerge, and those stocks will be the ones that surge. Meanwhile, people like Warren Buffett, Mark Zuckerberg, and Bill Gates have been selling stocks continuously. Warren Buffett is currently holding the largest cash position in his history. Money is no longer flowing back into the U.S. government. It's flowing into the pockets of major capital holders. So should you pour your money into stocks? You can probably guess the answer by now. It's not as simple as what mainstream U.S. media is telling you. And what will you do with all this information? If you don't understand the rules of the game, you'll be the one who loses money. But if you understand where capital is actually flowing, you can turn risk into opportunity. 2026 will be a year of extreme volatility. But for those with the right mindset, it could be a once-in-a-decade opportunity to build real wealth. Are you ready to take advantage of it? So in this context, what should we do next? Many people are worried about a collapse in the U.S. stock market, the weakening of the dollar, and the decline of asset values. But remember this, financial markets always move in cycles. When some people lose money, others inevitably make money. What matters is whether you understand where capital is flowing. Right now, institutional investors and major investment funds have already prepared for this shift. If you pay attention, you'll notice that experienced market participants are not panicking. They anticipated the change in capital flows and proactively adjusted their portfolios. In fact, market crashes are often the moments when real opportunities appear. Think about this. When stock prices fall sharply but the United States continues to print money and expand its balance sheet, what happens next? New money is injected into the economy, inflation rises, and eventually that money finds its way back into the financial markets. Those who are patient enough and perceptive enough can buy stocks at their lowest prices, right before the market recovers. This is exactly why Warren Buffett famously said, "Be greedy when others are fearful." But the real question is, which assets can serve as safe havens? At this stage, the most important question becomes, if you don't hold US dollars, don't hold US government bonds, and don't want to invest in high-risk stocks, where should you put your money? There are several asset classes that are likely to benefit from the coming economic environment. First, gold and precious metals. Gold has always been a traditional safe haven when the US dollar weakens. As the US expands its balance sheet and the money supply increases, gold becomes increasingly attractive. History shows that whenever central banks ramp up money printing, gold prices tend to rise sharply. Second, commodities and energy. Despite the growth of electric vehicles, oil remains a critical asset. When the US increases shale oil production, oil prices may fall temporarily, but other major exporters, such as OPEC, can still control supply to support prices. In addition, key metals like copper and lithium, which are essential for green technology and electric vehicles, are assets worth watching closely. Third, real estate in strategic locations. While commercial real estate may be collapsing, not all property is doomed. Areas with rapid urbanization and strong housing demand can still experience growth. Developing countries in particular may continue to attract capital flows and real estate investment as the US gradually loses its appeal. Fourth, technology and AI stocks. Even when the broader stock market declines, certain sectors continue to grow. Artificial intelligence is transforming how the world operates. Leading companies in AI, cloud computing, and big data could become destinations for capital once the market stabilizes. Fifth, cryptocurrencies, Bitcoin and digital assets. Bitcoin is often compared to digital gold and may benefit when the US dollar weakens. If you look closely, Bitcoin tends to rise during periods of inflation concern. If the US continues aggressive money printing, it's not unreasonable to expect cryptocurrencies to enter a new growth cycle. Key investment strategies for 2026. If you want to survive and profit in this market, you can't rely on luck. You need a clear strategy. Here are several principles worth following. First, don't hold too much cash. When the US dollar weakens, cash becomes a less attractive asset. Instead of sitting on cash, consider converting it into assets with real underlying value. Second, don't follow the crowd. Avoid being swept up by panic-driven news. When markets fall sharply, many people sell in fear. Smart investors use these moments to buy. Third, invest according to cycles. Every market moves in cycles. When you understand those cycles, you'll know when to buy and when to sell. Nothing collapses forever, and nothing grows forever either. Fourth, always have an exit plan. During periods of major volatility, you must have a strategy to protect your capital. This includes diversifying your portfolio, setting stop-loss limits, and never putting all your money into a single asset. The key to success in 2026 is not chasing headlines, it's understanding how capital flows are shifting. What we're witnessing is not the collapse of an economy, but a redistribution of wealth. Money doesn't disappear, it simply moves from one hand to another. Remember this: financial markets are like a chessboard. If you don't understand the rules, you become someone else's piece. But if you understand the strategy, you can always stay one step ahead and win. Prepare yourself now. 2026 will be a year of extreme volatility, but it will also offer tremendous opportunities for those who know how to seize them. Are you ready? Final thoughts. We've just analyzed 5 asset classes most likely to lose significant value in 2026, and the reasons behind these shifts. But always remember, in finance, where there are losers, there are also winners. The real issue isn't whether markets fall, it's where capital is moving and who understands how to act on that movement. History has shown that periods of major instability often give rise to the most unexpected opportunities for wealth creation. What matters most is not panic or following the crowd, but understanding market mechanics, building the right investment strategy, and staying one step ahead. 2026 may be a turbulent year, but if you prepare properly, it could also be a once-in-a-decade opportunity to build a strong asset base and move closer to financial freedom. If you found this podcast episode helpful, don't forget to like, subscribe, and turn on notifications so you don't miss future in-depth analyses. Share your thoughts in the comments below. Which asset do you believe will offer the best investment opportunity in 2026? Thank you for listening, and I'll see you in the next episode of Unsaid Truths.